So without further ado, I would like to give Catherine the floor. She talks for about 40 minutes. We open to Q&A also for those of you who are online, but then we close relatively strictly at 1 o'clock because we have to move to downstairs to Villa Schifanoia.
Make sure, can you hear me okay? Okay, wonderful. I am both American and European, just to be clear. I am a citizen of Ireland and Spain, long story, but I do have an EU passport, so I'm both. So it's a great honor to be here. I was at EUI last summer. Thorsten had our group actually meet. I think it's going to be in the place that we're going next. I'll hopefully recognize it, but what a beautiful setting. So I'm delighted to be here. I just wanted to say that the topic of this workshop is a topic everyone is thinking about. There have been a lot of recent books on this topic. And the one I was reading on the plane over is the Barry Eichengreen book, Money Beyond Borders, which was just published by Princeton University Press. But whenever there is a hot topic, first you see it in the media, then you start seeing books arise, so you know you're onto something. But this is a topic that is very much on lots of minds of international economists. I love this graph. This was actually put together by the IMF for one of their publications. And what it's looking at is Financial Times keyword occurrences starting in 1888. Financial Times was around back then until 2025. And all those spikes are when you see lots of articles coming out on topics, and the keywords include things like Bretton Woods, Triffin dilemma, which we'll talk about in a moment, dollar dominance, and so on. And I just want to kind of get people to, I think there's a laser here. Let's see. Yes. Check out the last little uptick here. It is actually higher than for the global financial crisis, and probably along the same lines of the European debt crisis. It's nowhere near the kinds of spikes that we saw earlier around Bretton Woods and the end of the gold standard, but something is going on. And there's a lot of articles showing up in the media around this idea of stability in the international monetary system. So again, a topic that is being looked at in books, looked in the financial media, and all of these are kind of typically organized around this theme of, is it important for there to be one country, the hegemon, that actually ensures global stability or not? And I'll get to the or not in a second, but Kindleberger is often kind of aligned with this idea, at least from the international financial system point of view, that you need one country that has a reserve currency that is going to serve as a lender of last resort and is going to maintain open financial and goods markets. So, if there isn't one dominant country issuing that reserve currency, the system is prone to financial crises. So that kind of view of the international monetary system is one that many people have held. He used the example of the Great Depression, and that was around the time where we were actually shifting from the UK pound to the US dollar. And his view was part of the instability that occurred in that time period was because the UK no longer could serve as the hegemon, and the US had at that point not agreed to serve as the global hegemon. So we were in this sort of middle ground. And these are just two, actually, let me point you to this last article here. Just came out in the Journal of Economic Perspectives. It's a really nice piece on the dollar shortage and basically the debate around what actually happened, and just read that again recently, and it's highly worth looking at. Okay, so I thought this graph was great. This is an extension of a previous paper by Barry Eichengreen and co-authors, and it just really nicely shows this idea of one country giving up currency dominance to another country. So the gold lines are the US. Just thought about that connection, Trump, gold. And the blue line is the UK, and the dashed line is the usage of each of their currencies. And you can see there's this time period during the Great Depression where there's sort of a shifting of those currencies. Interestingly enough, the share of GDP for the US already well dominated that of the UK when you go all the way back to 1900, but the actual shifting from the pound to the dollar took more time. And that's something maybe we want to take into account later on when we think about whether or not we're in a new shifting period. Basically, by the 1950s, certainly by the time the Bretton Woods system was put in place, we had then moved very much to a US dollar dominance system. But before that time, there was sort of a juggling between the two currencies, which I thought was interesting to look at in the graph. And let me just say that it's the share of the pound and the dollar as a reserve currency. Okay. So there was the Kindleberger view that you really needed one country that would basically issue the dominant currency, and it was important that it was one country. There's been a lot of discussion, starting with Triffin and the Triffin dilemma, but more recent papers that suggest, well, it may not be quite that way. That Triffin, of course, was looking at the gold standard, and his view was that the country that is issuing this reserve dominant currency would need to run current account deficits so that other countries would have access to dollars, basically that they would be selling goods abroad. But these deficits at some point would be unsustainable, and this would lead to a loss of confidence in the issuing currency. Then we have a whole slew of more recent papers. We have Pierre Livier that basically says if the relative weight of the hegemon in the world economy starts to decline, and I'm going to show some slides that might suggest that we are there or moving there, or if the hegemon is putting in place policies that are destabilizing, also something we could consider might be going on currently, that could actually lead you away from a stable to a crisis, a self-fulfilling crisis in his model. And then Farhi and Maggiore also have a paper that suggests if there's an incentive for the hegemon to want to inflate, devalue the currency, that would also be destabilizing. And then Caballero, in his, he has a whole slew of papers, it's just one of them, talks about this idea that if only one country is the issuer of safe assets, and this idea of safe assets I'll come back to, and the world needs more safe assets, that's another kind of tipping point that might lead you to instability, and in his case, move you to the zero lower bound and to the potential of secular stagnation. So there's been some conversation in all of these papers that would say maybe that kind of idea of one dominant currency is not necessarily the only stable equilibrium. So this is all kind of context and backdrop. Okay, so what's the plan for this discussion? So again, what I want to talk about is the current role of the dollar in the global financial system. I want to talk about how that dominant currency connects with systemic risk in the global economy. And then we're going to talk about future scenarios. We are in a moment where lots of people are wondering, are we staying with that one dominant currency? Are we moving to a different dominant currency or a multipolar world? And so that's kind of where I want to go. At the bottom here is a reference to a paper which doesn't currently exist. It's only in draft form, which is going to come out of the European Systemic Risk Board Academic Advisory Council, which I am on along with Thorsten Beck, who will be here later this afternoon. And this is a study that they've asked us to do. This is with co-authors, Robin Lumsdaine, Richard Portes, Antonio Sanchez Serrano, and Xavier Vives. And it's not actually due until March 2027, but we're well on our way. And so we're hoping we'll actually get it done earlier than that, but it wasn't quite ready for prime time right now. But the paper is basically also following this kind of plan that I laid out here of talking about what the role is of the dollar currently, what the potential systemic risks that could arise out of that, and then where we might go from here. So let's talk about dominant currencies. My guess is that most of you know that currencies typically play three main roles: store of value, medium of exchange, and unit of account. And so first thing I want to do is sort of walk ourselves through some of these subcomponents of what we mean by each of these and look to see where the dollar, and in particular, I'm going to have a little bit of a focus on the euro here as the potential currency that could end up being either in a bipolar or a multipolar world together with the dollar. So starting off, a great paper by a set of co-authors from the New York Fed created something called the Index of International Currency Usage. And it is basically looking at a whole number of different ways in which we think about currency usage, both in cash markets, in derivative markets, in banks, non-banks, et cetera, reserves. And kind of what you see here is something I'm going to be kind of showing a number of graphs that have this kind of structure. The blue is the the blue is the index, and the US by far has the highest bar here. I don't think anybody would be super surprised. The red is the share of global GDP, and the green is global trade. Whereas global currency usage for the dollar way outweighs what we see for the euro area or China here. When you look at global GDP and global trade, the differences are much smaller. And in fact, you could argue that trade is higher, both in the euro zone and in China. And global GDP, at least for China, seems to be kind of marching up. Depending on how you measure things, sometimes it's even above that of the US. So it's an interesting story here. We've got US dollar dominance, but the US economy is, as a share of the world economy, is not kind of dominant in the same way, nor are the shares of global trade. So that already kind of sets the scene that there are aspects of difference across these countries that might lead one to wonder whether or not this dominant position is going to stay where it is. Here's another graph that just kind of breaks down many of the components that are in that currency index. So it's looking at trade invoicing, foreign exchange reserves, international bank claims. I'm going to show you some more data on that in a moment. International bonds, Forex turnover, and usage of SWIFT, the payment system. And again, the blue line is the US, dominates across all of these. The next highest bar all the way across is always the euro. And then the other currencies, here we've got the yen, the pound, and the yuan are all much smaller across all these different kinds of contexts. Thought this was an interesting graph to look at. This is the share. So thinking now in the store of value, this is the share of foreign, so non-US investors that are holding US Treasury securities. And interestingly enough, again, see the kind of peak right before and around the global financial crisis. And there's definitely been a slowing or a downturn in the trend. Still pretty high. It is worth noting that many more US Treasury securities have been issued recently, so the denominator is getting bigger. So part of what's happening here is there's more Treasury securities out there. Just a smaller fraction of them now are being held by foreign investors. And I actually on the panel of economic advisors for the Congressional Budget Office. And this is a time series we look at very carefully because part of their job is to think about what is going to be the cost of financing these US Treasury securities. And in the past, again, there's been this kind of large demand coming from foreigners, both official foreigners and private foreigners, and they have also seen in their data this kind of slowing down in the share. Again, I want to be clear, the denominator may be doing much of the work here, but it is interesting that there's a little bit of a decline here. No decline here. So this is, again, a measure of store of value, and this is looking at balance sheet US dollar liabilities of banks headquarters outside of the United States. So this is the demand for dollars in the banking sector outside of the United States. The big light green line is other. It's everyone, and it tends to include lots of countries where you're allowed to hold dollar-denominated deposits. And many of those countries are emerging market countries or developing countries. But the bottom blue or turquoise is the euro area. And one of the things that we look at a lot in the European Systemic Risk Board is the exposure of European banks to the US dollar. And this is just showing you that it's significant. Okay, another measure that's sort of worth looking at is how much US cash, no return, is held abroad. 45% of all US cash is held abroad. That's based on data through the end of 2025. A little over $1 trillion. It's, again, obtained typically through trade. You could think about it as a special form of federal debt that pays no interest. It's an interest-free loan for the United States, having this cash outstanding. And you can come up with an annual benefit. This is a component of seniorage, not all of seniorage, which is just the amount of currency abroad times the interest you would have had to pay on federal debt. And that's about $40 billion for the United States. So that is substantial. When we think a little bit about some of the benefits, say, to the euro area of moving into a more dominant currency position, this is one of the aspects of this that you might want to think about. Euro holdings would actually be an annual benefit, and they would be larger if the currency was more widely used. It's weird for me to keep talking without anybody asking a question as an economist, but we are going to hold questions to the end. But if I say anything that's you're puzzled by, please do just let me know. So another aspect of things that we need to take into account is the medium of exchange and basically the role of central clearing and payment systems. Here's another place where the US is has a very dominant role with Fedwire and chips. Even SWIFT, which is headquartered in Europe, is largely denominated about over 50% in, or at 50% in the data from early this year, is US payment messages. So even though it's a European system, it definitely is dominated by US payments. Interestingly, there are a bunch of relatively new non-US payment systems, and they're arising unsurprisingly, out of areas in the world where either the US have sanctions or there are other reasons why people don't want to be using dollars. So one of them is CIPS, which is backed by the People's Bank of China. There are a bunch of different BRICS ones in Brazil, India, Africa, and then we're going to, I think, talk about later this afternoon, this Enbridge project, which is originally was a BIS project, now is actually going to the individual central banks, but it's a digital currency platform for payment settlement. Again, sort of making it easier, presumably, to do these kinds of transactions without using the dollar in the middle. So I mentioned before, all these new systems are partially arising because the current system allows the US to basically put in place sanctions that exclude foreign banks from using the main payment systems, Fedwire chips, and to some extent even SWIFT. Definitely North Korea, Iran, and Russia are all in that category. There is something called the Section 311 of the US Patriot Act, which is what is used to actually legally put in place these sanctions, these financial sanctions. So before I talk a little bit more or show you some cool slides about how these sanctions might work, let's just sort of step aside for a moment. There are other things, and many of these things are going to be talked about this afternoon. There's sort of the legal and institutional frameworks that are currently very much set up to continue dollar dominance. There's economic and military power. There's clearly been evidence in the past that allies of the dominant currency country are more likely to use the dominant currency. But we also have this ability as the dominant currency to weaponize the currency against other countries. I already mentioned sanctions, and those are going to be the countries that are going to be the innovators of ways of using currencies other than the dollar. So let me show you some very cool slides. And I just need to say, I know everyone's worried about AI. These are AI enabled graphs. I asked one of my graduate students, I said, is there a way to visualize what's going on with Russia? And literally in my office, he put together these slides. I was just blown away. So let me tell you what we're seeing here. So over here, we have the non-sanctioning countries, and to the left, I guess, on your side, we've got the sanctioning countries. This is capital markets, and the dotted vertical line is when Russia invaded Ukraine. And so we see that, and it's worth noting, the vertical axes are quite different. So I don't know if you can see it, but the vertical axes for the sanctioning countries are orders of magnitude higher, unsurprisingly, because these are all, this is Europe, the United States, Japan, et cetera. And the countries over here, the capital flows are lower, but you can see that there hasn't been much change in capital flows for the non-sanctioning countries and really dramatic falls in capital flows. So the color coding is blue is equity and orange is portfolio flows. And if you wondered, are these sanctions working in the sense that do we see fewer flows in both these kinds of assets after the sanctions? Answer on the capital side, clearly yes. But next slide, goods markets. Okay, here the color coding, we should have used different colors, a little confusing. Now we've got exports from Russia and imports into Russia. Now the orange line or gold line is non-sanctioning and the blue line is sanctioning. I just thought this was super interesting. They're basically substitutes for each other, right? So as the blue line, the sanctioning countries are both importing less and exporting less to Russia. Basically, the non-sanctioning countries are going in the opposite direction. And most of this is oil on the Russian export side. But it looks like even though capital markets, it's more dramatic, the fall in both sanctioning and non-sanctioning. Sanctioning countries are less involved in the financial markets. On the good side, there is this real split between sanctioning and non-sanctioning countries and a very clear substitution effect, which I just thought was super cool. So AI is not all bad. It can put together great slides. I did check all the data to make sure it was correct because I want to make sure.
Any from used to be a guy who says that a lot of the red line in Germany rerouting exports to Russia.
That is, I don't know. I did read that Substack, which is really interesting. Yeah, I mean, he's great at figuring out all the ways in which the data is probably covering things up on the reserve side as well. And I actually don't know. That's a great question. I will check. I think from the exports to Russia, I think a lot of it is India and China, but it could also be Europe. Great question. See, interrupting is a good thing. Okay, a couple of other things before we move on to the next topic. So central banks play a really important role in basically kind of keeping the dominant currency system in place. Swap lines for the US dollar. Worth noting that both the ECB and the People's Bank of China also put in place swap lines during COVID. But those are a really important way in which dollars are made available to other countries. I put temporary and standing. We've got standing swaps across most advanced economies. And I'm sure people have read the UAE now has asked for swap lines with the Fed. I don't think they've decided yet if they're going to get them, but that's very unusual. It's very unusual to get a swap line for a country like the UAE. Repo facilities, market maker and lender of last resort facilities, payment systems we've just talked about, settlement systems, access to central clearing counterparties. And I'm gonna a little bit underline this last one, digital currency. So here is one place where the US is a laggard. The Fed has not issued a digital currency. It's thinking about it. It's been thinking about it for a long time. The Euro area is already on track to do so. Japan already has one. China already has one. So it's an interesting feature that the Fed has not gone there in the same ways as other central banks have. It is worth noting, even though people focus a lot on the swap lines as being a really critical piece of how the Fed kind of keeps the dollar dominance system going. The blue line here is foreign official deposits that are US denominated balances and securities held at the Federal Reserve by foreign central banks, national governments, and international organizations. And it far exceeds swaps. People don't quite realize that that's like a really important source of liquidity. The dark line is foreign official holdings of treasuries, and I guess it looks like a brown line is those treasuries that we talked about that are held by foreigners. But I think we see the little bump ups on the swap line. That was the financial crisis and COVID, but it's really a pretty small part of the liquidity system relative to these deposits. Okay, so next topic is how does dominant currency kind of connect with systemic risk? So There are lots of different ways we could go, and this is where most of the work of the co-authors on the paper are spending time on, and this is where I have fewer slides because we're still working on it. But what we want to think through is what is the transmission of shocks from the dominant currency country onto other countries. And so I am going to show you some data on portfolio flows. Obviously, there's trade balances and bank exposures. Monetary policy spillovers is a really interesting area, sometimes a little hard to be able to decompose what the own country's central bank is doing versus how Fed policy is affecting things. But there's not just transmission of shocks, there's also the potential for amplification of shocks. So this is where the systemic risk part of this is important. We do see some synchronization of cycles, often coming from external sources like COVID. I don't know if you think about the financial crisis as external, but it certainly hit everyone. But you're already, once you have a dominant currency and you are using it widely, you're more vulnerable to sudden stops. Anything that happens that makes it harder for you to borrow in dollars in this context, sanctions, which we've just talked about, any kind of adverse regulatory actions. There was some talk at the beginning of the Trump administration that foreign investors would be taxed more than domestic investors. That hasn't happened. I think it's illegal, but it's something that's in the air. And then more generally, policy dependencies, dependent on any policies that are put in place in the dominant currency country. So this is just I love these diagrams. This one is just looking at the global network of portfolio flows, investment fund shares. And again, turquoise is the US. It's a really, really large part of the foreign equity position. Or put in other words, much of the world is holding US equity along with US citizens. Likewise, this is portfolio investments, again, really huge. So this says foreigners are holding a lot of US equity and portfolio investment in general, and that is going to mean that any impacts on those markets are going to be felt all over the world. So what other kinds of things do we need to worry about? The US banking system is itself vulnerable to runs, although there are policies in place to try to forestall that. But any extraterrestrial, so any time that banks outside of the United States are holding dollars, and I showed you graphs before suggesting there's a lot of that, they are going to also be vulnerable to those runs because any transactions that involve the dollar are going to touch the US financial system in the ways in which things are set up currently. They always have to settle through US banks or the Federal Reserve. We've got the swaps and we've got FEMA, the Foreign and International Monetary Authority repo, but there is always this concern that if something happens in the dollar market, that it's going to very quickly move to markets outside the US. Okay, exorbitant privilege. We know, well, actually nobody knows when it was actually coined. We think it's Giscard d'Estaing, but nobody's actually been able to find the quote. But in the 1960s, he talked about this idea that the country that issues a dominant currency kind of has, and there was a flavor of undeserved benefit. So I want to talk through what the kind of components of exorbitant privilege are, and then show you some graphs suggesting that maybe that privilege or benefit is eroding for the US. I'm just looking at the time. I have got to hurry. So I'm just going to go straight to the graphs because I think you guys all know what exorbitant privilege is. So first thing, and I think this is probably the key graph. So the red line is the net asset position for the United States, and the blue line is the net income balance. And typically we would expect if there was exorbitant privilege that the blue line would basically not be falling as quickly as the red line. And that was true through the early 2000s, even until about 2019. But since that time, net income has actually been falling pretty dramatically, even to the point where in 2024, we saw net income actually falling farther than the net asset position. And this is not what we'd expect to see if the US was in fact getting this exorbitant privilege. Just because I'm going to take privilege of slipping through slides so we can get to the last topic, but the rest of the slides, which you guys will all have access to, are just sort of walking you through exactly what's going on there. It's worth noting that convenience yields, as we look at US Treasuries, are sometimes people say disappearing, others would say lost. It's also true across the board. Lots of countries are seeing their convenience yields fall. There does seem a little bit of evidence that the US has more fiscal space. The US is the purple line. They do have the largest fiscal deficits of the G7, and maybe that's because of exorbitant privilege. And certainly the US has these accumulating current account deficits, which again may be part of exorbitant privilege. On the other side of privilege is duty. And one of the things that we see for the country with the dominant currency is that they are going to be the place that people go as a safe asset in times of crisis. That country will be kind of required to be the provider of global liquidity, and it may even be required to take into account the rest of the world when it thinks about its macro policy. And one piece of evidence of that is that it does look like the US dollar strengthens during crises. So we've got COVID and the global financial crisis here. COVID was less big than the global financial crisis, which some people would say that the duty is sort of less great than it was before. So just to summarize where we're going, we do have evidence that the US Treasury market is still considered the global safe asset. We don't really have evidence, I didn't get to go through it, but that there are higher returns on external assets than on external liabilities, which is why exorbitant privilege is going away. It's certainly not true for bonds. And it is still true that the US is able to run these large trade deficits. On the duty side, it does look like the US continues to serve as the issuer of safe assets. Okay, so now let's get to got 4 minutes to talk about future scenarios. So I already talked a little bit about the sanctions issue. Europe is seemingly on a path where it might start to look like it fulfills many of the kinds of characteristics that we would want to see. China is out there as well, less interested seemingly in international holdings of the yuan, but it's clearly moving and growing in interesting ways. And then there's this issue of non-governmental digital currencies, and in particular, stable coins. It's actually going to work in the opposite direction here because most of them are dollar denominated. So I'm just going to zip through this very quick. One big issue here is, doesn't look like, just as Kindleberger talked about the US during the Great Depression, doesn't really look like any country is really on the cusp of being able to take on a lot of the aspects of a dominant currency. So we'd want to see more green. The Eurozone has light green. Japan and even Switzerland have some dark green, but we don't see another country sort of obviously greening here and ready to take on all these markets that are listed here. This is actually a graph that Thorsten put together for a talk that he gave yesterday. And this is just looking at safe asset international comparisons. And again, the Eurozone, one of the big questions is, will there be more Euro bonds. That's a big question in Europe right now. The US treasuries are very much the dominant safe asset. There was a speech by Lagarde last May, actually on this day, right? Since the 26th? No, yesterday, talking about what would need to be done for the euro to basically become a dominant currency. She talks a lot about the history that nobody stays dominant forever, and that maybe Europe should be thinking, or the Eurozone should be thinking about what it needs to do in order to sort of be ready if the mantle is passed along. I thought was interesting. And the euro would obviously get all the benefits that the US currently has. So I won't go through this. It also would take on this duty, which has some negative things. Finally, 3 scenarios. So in our paper, we're going to talk about 3 possible kind of future trajectories. One is a kind of slow drifting away from the US dollar. This honestly looks like the most likely scenario. We are already seeing a little bit of that happening, and you could just imagine it continuing. There is an alternative scenario, which is that digitization actually goes in the opposite direction. Stablecoins are, I think it's like 90% or even higher, denominated in dollars. Basically, they're backed by US treasuries. So that could actually reinforce the current dollar dominance. Or we could have the sort of, cataclysmic fall off the cliff. Nobody wants to hold dollars anymore, and we have to go somewhere. And maybe that somewhere would be the euro. Interestingly, it's very hard to get data on scenario 3. And we don't really see historically lots of examples of scenario 3. This might be one of those everything moves slowly and then all at once. So it looks in retrospect like it was more like the slow drift, but in real time, maybe it felt more like 3. But one of the things we want to think about is across all 3 of these scenarios, what does this mean in terms of hegemonic stability? And if it is scenario 2, digitization, that's the critical piece here. We tend to think of that as much more fast moving than some of the other kinds of ways in which we've seen currencies being used in the past. So that could be the speed aspect of number 3, again, depending on whether it is connected to the dollar with stable coins or outside of the dollar system. So there's been some very recent work trying to look for evidence of how things are, and in particular, the Tariff Liberation Day announcement is typically used as the natural experiment. When that announcement was made by Trump last year, how did that affect both markets and the use of the dollar? Basically, both of the papers I have here suggest, yes, there was the movement away from the dollar. Yes, it had an impact, but pretty small. Nothing like no longer does anyone want to hold dollars. There's also been some analysis of the Chinese renminbi or yuan, and again, nothing very dramatic yet. So those were just those 2 papers. I'm guessing just as we've gotten all these books, we're getting lots more papers. There are a lot of papers about convenience yield and finance, basically showing that it has been eroded, not just for the US, but for most countries. I think there'll be more and more things where we want to identify events that then potentially affect the dominance of the dollar. I mentioned, it's not 90%, it's 99%. 99% of stable coins are backed by US treasuries. It right now seems to be the main kind of digital currency that is being used outside of the United States, largely in countries where they don't want to be touching dollars directly. The Genius Act in the United States stands for Guiding and Establishing National Innovation of U.S. Stablecoins. It really has helped stablecoins grow. Europe has been much less enthusiastic about creating a stable coin and making it easily used. And that is one question, whether or not that there is going to be a digital euro. And so maybe the idea is you don't want both a digital euro and a digital euro denominated stable coin, but it is potentially something that would counteract some of the other things that are moving us away from the dollar. I looked high and low for some good evidence of this sudden shift away from a currency. Steve Kamen is probably the only person who sort of suggests that this could happen. And his paper here kind of talks through the Russia case. I showed you the data earlier, but as the US weaponizes the dollar in more and more ways, we may see countries coming up with innovative arbitrage opportunities to get out of the dollar, and that could lead to this sort of more fast action shift away. I think that's, okay, so ongoing, where are we going? I love history, so we are working really hard to pull out historical examples to try to have a little bit more sense of this slow shift versus sudden shift away. My reading so far is I still haven't found a sudden shift away example. If any of you have one, I want to hear it. But basically, are there lessons to be learned about the triggering circumstances that sort of move us? Great Depression was clearly one. That was a big one. Are there others? I think I mentioned we are looking at this transmission mechanism through Fed policy onto other countries. And of course, given that currently the US has these huge imbalances and maybe has some evidence of exorbitant privilege, if we shift away from the dollar, what exactly would we see in these key areas? So it would suggest that it would no longer be the case that the world would basically lend to the US to fund future current account deficits. That could have a really interesting, potentially destabilizing effect. The US is the big consumer of the world, and if they can't do that anymore, that would be very destabilizing. Exorbitant privilege maybe before was something that people were more concerned about. It seems maybe that is less of an issue since we're already seeing that erosion currently, not only in the US, but across the board. So that, I believe, is my last slide. Yes, it is. So sorry, I went 5 minutes over, but I want to open it up to questions.
Thank you very much indeed. I would have been shocked if you had managed to present 50 slides within time. So yours.
I had more. I deleted a lot on the plate.
There was so much to say. Is there an urgent, quick question? Then turn on the microphone at 10.
Hi, Jonathan Zeidler from the Schumann Center. My question is about one element of your exorbitant duties, and that is the provision of safe assets. So obviously, as you emphasized, a lot of the debate about the international role of the euro revolves around, would the euro be able to supply enough safe assets? The question is, if we look at the American issuance of treasuries, to what extent is that actually motivated by trying to service the international demand for dollars, and particularly if there would be, let's say, a conflict between domestic priorities and international priorities? Do we see, or have we seen in the past, American authorities saying, "Oh, we have to issue treasuries because there's a demand for it abroad," at least since the Marshall Plan era?
The only time I recall that conversation happening was around 2000. There was a whole lot of papers. I feel sorry for those who wrote them. It was like, oh no, what if there are no more Treasury securities because the U.S. Fiscal deficit had, or the fiscal debt had shrunk, and there was less need to borrow. I have to say, I saw absolutely no conversation during that time period of, even though we don't need to borrow, we should borrow so that we can provide more safe assets. That was not part of the conversation. In the current US, there's sort of no evidence that there would be a proclivity to worry about the rest of the world. So there is a proclivity to spend a lot. So we may well be issuing more safe assets. Whether or not they remain safe is an interesting question. But I don't think any concerns about the need for safe assets abroad would be the driving force.
My underlying point is that you could argue on that basis that the issuance of safe assets is a byproduct and not a conscious policy.
Yes.
I also want to give
Thank you. I have Daniela Gabor from SOAS, University of London. I have a small conceptual question and I suppose a bigger one. The small conceptual question, I was surprised when I heard you reflecting on the transmission channels from US monetary policy stance that you didn't mention the work of Ellen Ray and the global dollar financial cycle. Is there a reason for that?
No, I do believe there is a global financial cycle, and that is definitely part of our analysis.
But you don't think that's a useful conceptual framework to think through when you draw up your...
I do. I mean, the global financial cycle seems to currently be largely driven by dollar financial policy. So the global part is a little bit of a misnomer. I think the dollar financial cycle then impacts the rest of the world. That I definitely, so we are taking that kind of modeling framework, but again, it is an interesting question. If it's no longer going to be driven by the dollar cycle, then what would it be driven by? And again, I don't think in the last 50 years, we have evidence of anything other than a US-driven cycle.
Thank you. And the bigger conceptual question is, I want to push you a bit on, you had three scenarios, status quo, slow or fast away from dollar hegemony, right? And I would like you to reflect a bit on the causal mechanisms that are driving these scenarios and the political economy of each. For example, in Europe, there is very clearly from the ECB, there is very clearly a push for, let's call it, I don't know, monetary sovereignty, financial sovereignty, however you want to call it. The digital euro is a response to the Trump administration's push for stable coins. There are worries about, I'm going to finish with this, there are worries that Donald Trump's administration will not allow the Federal Reserve to provide lender of last resort or market maker of last resort facilities for the rest of the world. So where is the politics in your analysis?
Yeah, no, I mean, the politics are exactly as you suggest. The US looks like it wants to give up its role, certainly the duty role. I'm not sure that they, quite understand that they will also lose some privilege, but the data don't suggest that yields are really much lower in the US than they are anywhere else. So if you're not getting the privilege and all you've got is the duty, I think is the thinking, then why have a dominant currency? And Europe is sort of in the opposite stance. I think the view is it might be worth trying to take on this position, presumably partly to get that exorbitant privilege. And, you got to take the duty with it. But certainly all the talk by both central bankers and politicians would say the US seems to be a little bit like, okay, if somebody else wants to take over, we're good with that. And Europe saying, actually, maybe we're interested in disentangling ourselves from the US dollar system. And if that needs us to take on the role of the dominant currency, maybe that's okay. What is interesting to know is, would both countries be willing to have a bipolar world? Or, might there even be a would China also be in there? And again, we've had this long-standing view that we only need one, for stability, you need one. But we might be in a place where it actually makes sense that each country wants some kind of both discretion and less vulnerability to each other by kind of creating their own system, but that none of them would want to take on this really kind of one hegemon role. It's very hard. It's hard to tell right now exactly. And again, the tricky part is Euro is the closest, but it's pretty far looking at all the graphs. It has a long way to go. And the safe asset, I think we will probably talk about this afternoon, but I mean, that's a whole conversation of how could there be Euro assets given the fiscal structure of the Euro area, and how quickly could those become safe assets? Somebody in a meeting I was in yesterday were saying the boons right now are about 50 basis points above the treasury. And so like, would you actually, with the Euro bond, get below that? Like if you thought Germany was, and maybe you don't think Germany is the strongest country, but I think currently it has the lowest interest rate. You know, if you put everyone together, it's hard to imagine that interest rate is going to go lower than the Bund rate. And so then can that really compete as a safe asset? Big question.
I think you have set us up perfectly for this afternoon.
Oh, good.
Thank you so much. Thank you for your triggering